Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by Martyn Gilbey, UK Country Manager at Franklin Templeton. So thank you for joining me today, Martyn.
It's very nice to be here, Kimberley. Very nice, thank you.
So could you give us a bit of a background into yourself and how you got started in financial services?
Yes. We're going back a few years now, but I graduated in 1994, actually with an English literature degree, which is interesting. Wow. I don't know how many English graduates come into our industry or financial services or certainly investment management now. I suspect perhaps not as many as when I started, but I did start in in generalist banking. So I did a few years on a graduate scheme with a bank, and that's where I got my first exposure to investment management, alongside banking, obviously, and investment banking, retail banking, and a bit of insurance. And I kind of decided pretty quickly that investment management was the area of financial services that I was most interested in. And then I was fortunate enough to, with the bank that I worked for, had an asset management firm. So that's where I got the exposure. And then I got my sort of first job in the industry, and went from there. And that point about the degree is, I think, interesting because certainly at the time, not just financial services, but I think professional services, generally law, people were looking for a wide canvas of graduate knowledge and backgrounds and skills. And perhaps we'll touch upon this later, but I think, under the subject of diversity and inclusion, and just on particular diversity point, I guess, just making sure the industry attracts a wide slate of not just talent, but perspectives and people with different backgrounds. I think that's really important. So I would like to think that somebody who was an English graduate and interested in our industry would still have the opportunity to join us.
Yeah, definitely. I think at 18, when you choose that degree, you have no idea what path you want to go down. And then I think once you have graduated, you have a bit more of an idea. So I like that you were able to, move from what would be the arts to something, within finance. And I think everyone should have that freedom. I went from science to working in the arts, so kind of opposite. But yeah, I think there's no linear path anymore. And I think, again, going back to that diversity thing, that's the best way forward, just to be more inclusive. But I wanted to know, what is the current strategy and focus areas of Franklin Templeton in the UK, and how do they align with market trends?
Yes, well, look, there's a lot to unpack there. So let's why don't we start with the kind of, I guess, the business strategy, and then move on to what is currently going on, because it's, well, seemingly always fascinating, but I can't think of a time that's been this interesting, brackets challenging, for our industry, not just in the UK, but I think in many markets, as the current market in which we're operating. So I'm sure we can talk about that in a bit more detail in a second or two. I think in terms of our strategy, you asked about our UK strategy, and I think what's interesting there is we do have a UK strategy, which is a subset of our global strategy, and really the two overlap, or one is a subset of the other. I mean, globally, I think we are clearly on a path to do what we call building the firm of the future. That's really a reflection of the fact that our industry is going through so much change, whether that's regulatory, whether it's kind of market driven, as in markets, or whether it's client demand driven and innovation on things like technology. But there's a big pivot point, I think, in our industry. And for the last few years, certainly Franklin Templeton has been thinking very deeply about that. And then I think more impressively, actually, than just thinking about it, we've actually been putting our dollars, our investment dollars, to work to evolve and in some ways, excuse me, radically change our business model.
Mm-hmm.
And a few examples of that. Just since really 2020, a number of the acquisitions we've done have been, tick any of the above: building scale, adding new capability, responding to client demand. So the Franklin Templeton that I joined in 2017, I think, was about $700 billion globally of assets under management. We're closer to 1.5 trillion. Excuse me, now 1.4, I think. And that's not just scale for scale's sake. We can come back to why, from a business model perspective, we think that's important to either be, at the scale end of the market, or indeed very boutique-y, which is, I guess, the other business model that will work in the future. But we've also diversified our business. We've diversified in terms of client category that we typically serve. So I think the old Franklin, particularly in the US, was more retail focused. The Levinson transaction that we did, which was sort of transformative for us in 2020, had a bigger institutional client base. So we've rebalanced our business between retail and institutional. And obviously, the other area of diversification, apart from geographic, is asset class diversification. And that's the other, I think, there's been three sources that have been driving, sources of inspiration, if you like, that have been driving our M&A. One is the scale question I've already talked about. The second is technology, and I'm sure we'll talk about this more during our conversation today. Some of the investments have been around technology. And then the third area is really alternatives versus traditional assets. And we spent a lot of time and dollars on building out what is now, I think, one of the world's largest, certainly diverse, alternative investment platforms. So that's all about building the firm of the future. And that's not just componentry, that's not just kind of asset class or investment skill that we've been acquiring and bringing into our business. It's also, as I said, technology, but it's other things as well, I think, and we'll perhaps again talk about this. Clients, I think, are fundamentally, and when I talk about clients, I should clarify, I'm not talking about end investors. We're largely an intermediated business. So we distribute into the market through advisors of one form or another.
Right.
But those distribution businesses are themselves changing. There's a lot of consolidation going on in the pension market, in the wealth management market, in the advisor market, and we have to respond to that. And so I think our clients are looking to deal with asset managers in a different way, and that's also what I mean by building a firm of the future, in terms of just thinking about what partnership looks like, and what serving our clients looks like. And then the final piece of that, I think, which again we might touch upon, is talent. We need, back to our earlier comments, we need not necessarily different skills and knowledge in investment management. We need people from different backgrounds to employ those skills and knowledge, and I think that's critical for a critical component part of our business strategy.
Yeah. And I wondered, in your role, what key trends are you observing within the asset management sector as a whole, and what challenges and opportunities do you see these trends presenting?
Yeah, it's a great question, Kimberley, because I think, as I mentioned earlier, this is really one of the most challenging times I can remember in my career, in terms of where markets are, where client confidence is. There's a lot going on a macro level in the world around us today, whether that's geopolitics, whether it's innovation and disruption coming from technology, whether it's the regulatory landscape, which I think is as busy as it's ever been. So there's a lot of inputs that create a big output called challenging markets. And as I say, it's certainly more intense than I remember the sort of period around 2016 when we had the Brexit vote in this country. And I'd say it's on a par and perhaps even exceeds the great financial crisis in terms of its longevity. I think back to the crisis, that felt existential at the time. I'm not sure there were points in sort of 08, 09 where we weren't sure what the future looked like. But actually, policymakers, governments, the industry made some pretty radical, bold decisions, which actually quite quickly reverted us into a period of, looking back, what now was a period of cheap money and high growth.
Yeah.
This market that we're in at the moment, which has lasted 12 months and could last well into next year, feels it's certainly longer in terms of its duration of impact on people's confidence to invest. So it is a challenging macro environment. I think I was listening to a bank CEO give an update last couple of weeks, and they were saying that geopolitics in their career has never been as important and is the number one risk that we're all faced with. And there's obviously some obvious geopolitical risks, around what's going on in the Middle East, what's going on with Russia, Ukraine, potentially kind of China's expansionist strategy. All of these things have a bearing on investor appetite and investor risk. By the way, they're not all negatives. I mean, in any scenario, there will always be an optimist looking at, where is the investment opportunity? And a good example at the moment is a lot of investors are looking more closely at India, for example, as a hedge to where China is in emerging market indices and Asian indices. So just one example of where people pivot and they sort of think and look for other opportunities. And that's in no way to say that China doesn't represent still a credible investment case. It just means that people look through that lens in a different way. But there's some other geopolitical angles which I think are really interesting. And somebody said to me the other day, I found this very interesting. I think it's the only time it will ever happen. In 2024, 4 billion people will have an election that is, by any measure, free and fair and democratic.
Yeah.
And what's more interesting than 4 billion of whatever we are, 7.5, 8 billion people, more than 50% of the world's GDP is represented in those elections. Wow. So 2024 will be a standout year for testing the democratic model, for seeing where democracy goes in terms of right, left, polarization, globalization. All of these things I think will be front of mind for investors, for money managers, and so it's a very interesting kind of market condition that we're facing. And then of course you've got some fundamentals like we're still dealing with inflation. Have interest rates peaked? Are they going to come down? Where do Western democracies in particular, and we can talk about the UK, where does growth come from? Because it all looks pretty anemic. And if you saw Andrew Bailey's comments last week, potentially downgrading the next 2 years worth of forecasting growth for the UK, it all looks pretty grim. And we're seeing, just in terms of where the demand has been for cash and short duration funds versus kind of active management and perhaps risk on investment strategies, all of that combined is made, as I say, for a difficult current investing landscape. But people have to make money. We are one of the structural themes in the UK is that for the last 10 or so years, perhaps a little bit longer, as individuals in the UK, government policy has effectively meant that we are all taking more responsibility for our own, financial well-being and long-term savings and investments security. And I would argue, I think lots of us would argue, the industry has not fully adapted to that new reality. We haven't seen the innovation around advice and guidance that I think we need to see, so that more people have access to appropriate advice or guidance. But the reality is, no one's going to do that for us. We're going to have to do that ourselves. When I say we, I mean we as individuals, a society, and our industry that supports the UK consumer. So we're all going to have to get a lot better at this and get more involved. I think we're going to see another trend is we're going to see more individuals taking more interest and getting more involved in their long-term savings and investment strategy, in their financial well-being. I think that will put pressure on regulators and policymakers to accelerate some of the improvements we need to see. Whether that's, for example, pensions dashboards, wealth management dashboards that effectively give you the same access to your investment savings products that we can all currently get through sort of open banking on our current accounts. That's really, really important. I think DC schemes, their current kind of approach to being more obsessed with cost than perhaps value is constraining DC pension schemes' ability to invest in alternative assets. That has to change. I mean, that's the government saying that has to change. That's not just industry saying that's a good idea.
Yeah.
And we're seeing, consolidated DC pension schemes as an idea. I think a fantastic, innovative idea to challenge kind of the old DB schemes.
Yeah.
The pot for life concept that we've certainly at Franklin been thinking about for a while. We was really pleased to see that in the latest update from Treasury, which is all about empowering individuals rather than as individuals are being told by our employers or by advisors employed by our employers and telling us what to do.
Yeah.
So I see lots of change. I think more democratization, more customization and personalization, driven by technology and driven by regulation. But that should all net out to a position where we're better informed as a country. People are taking more responsibility, making more active decisions, relying on a better advice framework to support that. Because let's face it, we can't all, be IFAs and deal with our own money. So I'm very optimistic about the future, notwithstanding the fact that current markets are pretty challenging.
Yeah. No, I think I like that viewpoint. What I've been seeing is that there will be a bigger need for advisors for sure in a lot of these decisions, and hopefully the demand will be there. Going back to that conversation we had right at the beginning about whether like an English graduate might want to move into this particular field, but I wanted to also know if you could provide any insights into the conversations you are currently having with client groups. What are they most concerned about? What are they most interested in knowing more about?
Yeah, so look, I think if you speak to a lot of clients at the moment, our clients, then traditionally we would have an investment-led conversation. So where is your asset allocation model? Where are you underweight, overweight, asset class, the asset class? And for example, with equities, where are you on global versus regional versus single country? Where are you on growth versus value, etc. That still persists, but it's notable that those conversations are often secondary to how on earth am I supposed to manage the consumer duty? How do I incorporate that into my business model? How do I make sure that I can sleep easy at night, making sure that we are, doing the right thing by our customers in terms of regulatory change? Asset manager would say, we spend a lot of time now on. I have spent a lot of time on it, on assessment of value and then consumer duty, and then we look forward and we think about SDR, and we think about consultations on just today. Consultation paper came out on the offshore funds regime, which is a big issue for big groups like ours. Government policy on pensions really does percolate directly into the industry because smart people are trying to think about how we can innovate to deliver not just the government mandate on kind of unlocking or unlocking growth by increasing investment in UK equities in particular and alternatives, private markets from pension scheme money. So the client conversation has been enriched, if you like, by lots of things that aren't just pure investment conversations. And often it comes from these conversations start from a position of kind of scratching your head and thinking this is a problem I have to solve. When it gets into that solving area of the conversation, that when it becomes very powerful, and it loops back to that point I made before about it's a different way in which traditional manufacturers like ourselves as investment managers are talking and engaging and partnering with our customers who tend to be more of the distribution businesses. So I think the kind of it's a long-winded way of saying when we meet clients now, we're not just talking about bonds and equities and hedge funds and real estate. We're talking about consumer duty and tokenization and sustainable finance and lots of other related points. The other conversation starter that I've been having recently with people, two things really, they stand out for me. One is, the UK is the world's second largest investment management market by AUM, second only to the US. And actually the US, although it's much, much bigger, it's really a domestically focused market. So you could argue the UK is the world's leading international asset management market. I think we manage 40% of our AUM here is managed on behalf of overseas customers. We manage 30% of the EU population's investments, which in aggregate is bigger than France and Germany and the Netherlands put together. So we're a sizable market here. When we look at the market every year, this year, for example, we think no more than about 3 to 4% of the market will move in terms of new money. So we call it money in motion. So either new money coming into the industry or money being, customers, clients switching from one fund group to another in the same asset class. So, that's telling you that let's call it round numbers, 95% of a £10 trillion market is static and is not moving. And of course, you wouldn't want to see 100% turnover in any market because that's not healthy in terms of the fees that the underlying customers will pay. But it still seems to me a relatively small amount of the money that we manage in this market kind of seeking a new home, looking for better returns, different strategies. And so I think that statistic tells you that there is plenty of room for innovation and growth for smart managers. The other statistic that I it's quite alarming actually. And again, one of the wealth management CEOs said this to me the other day in passing, that of the adult population that should qualify for some form of financial advice, so not all adults, but just those who will have a level of assets or wealth at some point in their life, which means they probably need some advice. The percentage number in North America, is 34%. So 34% of people that ought to get advice do get advice. The equivalent number in the UK is 8%. And that is quite an alarming statistic. Now, statistics down to statistics. What's partly driving that is we have, pension freedoms, we have the growth of the defined contribution market, still really in its accumulation phase. Most of us have not yet got to retirement where we're having to make decisions with our DC pots, which are going to be fundamental to our long-term well-being in retirement. So the number's relatively low because a lot of us haven't yet got to the point where we need that advice. But it still tells you that we are underserved in the UK market for advice. And if I was an IFA, I'd take great comfort in that statistic and think I had a lot of growth ahead of me as an industry and as a firm, as an individual IFA.
And I wondered, in today's market, what opportunities do you see for both investors and asset managers, and how are you positioning yourselves to capitalize on these opportunities?
Good question. I think at an asset class level, the big opportunity for me structurally is what we call the democratization of alternatives for retail customers. So essentially at the moment, alternatives which, let's face it, are quite expensive. They're capacity constrained, which is partly why the price is where it's at. They're generally illiquid. So we're talking about, hedge funds, private equity, private credit, corporate real estate. These are underlying asset classes that tend to be, and have historically tended to be, accessed only by the smartest kind of institutional at scale investors.
Right.
I think everybody in this market, for example, and I mean by that government, policy makers, regulators, and the industry certainly have recognized that it's kind of not fair that retail investors can't get exposure in a full asset allocation model to the same broad makeup of assets that institutional investors can.
Mm-hmm.
So, I think the advent of the LTAF that we've seen in the last 12, 18 months, world record timing for government, regulator, and industry to get together and create this new vehicle, which will, is one way that we will enable retail investors to start accessing private market exposure. We don't want to rush into it, right? Because it is an asset class that's constructed the way it is for specific reasons. You can't hold a 10-year lockup private equity fund in a daily dealing UCITS fund. It's not the right structure. But nevertheless, from a generating a well-balanced, diversified set of returns on your investment profile, we have to find ways for more retail customers to access alternative investments.
Mm-hmm.
So that's one very big area, I think, of demand and trend that we're going to see. And as I said earlier, Franklin Templeton has been very active in that space. We've acquired Alcentra and in the private credit space, and Lexington Partners in the private secondary private equity market. Both of those are UK-based, world-class alternative managers.
Mm-hmm.
That are UK based. So we have products in the UK, but they distribute globally as well. We're looking at an unlisted infrastructure manager. So that partly kind of answers your earlier question as well. What's our UK strategy versus our global strategy?
Yeah.
I don't think you can be a global asset manager unless you are at scale and are taking advantage of the skills and resources that are available in this market. I think the acquisitions of Alcentra and Lexington and anything else we do, which are UK-based businesses, is testament to that. Apart from alternatives, I think there's a couple of others. Retirement income is going to be a big theme.
Yeah.
Lots of people in DC land have been and are necessarily focused on the accumulation side of that trade.
Yeah.
We're all thankfully young enough to be hopefully accumulating wealth rather than spending it.
Mm-hmm.
There is going to come a point in demographics where more of us reach that kind of minimum threshold of 55 at the moment. I know it's going up in a couple of years to 58. But more of us are going to have access to our pension pots earlier, and they're going to have to make some fundamental decisions about how we use our pension assets in particular in a different way to sustain greater longevity, living longer retirement, and needing an income from those assets. So I think retirement income used to be the preserve of either an annuity or some kind of income drawdown or a combination of those two things. One of the things that the pension freedoms legislation did in this country was to open up that market to lots of new innovation. And we haven't seen too much of it yet. It's tough because most smart people can hedge interest rate risk and they can hedge inflation risk. What you can't hedge because you don't know is longevity risk, because we don't know how long each of us is going to be around for. So it's an area I think of great demand, and we have yet as an industry in total to see some really good innovative products coming through. So you've got alternatives for wealth, for retail, you've got retirement income. And then I think the third area of innovation or demand that we're going to see is technology driving greater customization. And again, Franklin Templeton, particularly in the US, where we're seeing some of these trends being more developed than they are here. We've spent money on investing in smart technology in the US that I think will have applications in markets like the UK, which, without boring you now, they're in two areas really. They're around the area of tokenization. So how do we use blockchain technology to drive greater efficiencies in the way that we operate our industry, and that has to be to the end benefit of the end investor, paying less for the important, but dare I say it, slightly more boring bits of how we deliver investment management. So there's the whole blockchain tokenization world, and then the other world that's interesting is, as I say, personal finance technology, which enables that. It loops back to my earlier point about we're all going to have to take more responsibility for our own financial futures. We're going to be using our phones and potentially engaging with different forms of advice, hybrid advice, doing our research. I think technology that can only happen if we have trusted, smart, algorithmic, technology that can be trusted and is going to enhance the way advisors do their jobs and the way smart investors engage with advisors and do some of their own stuff as well. So those are the sort of on the more retail side of the business that I see the sort of trends that are pretty much upon us now, actually.
Yeah, definitely. I think that also contributes to transparency for clients and everyone who's using those services, especially with something like blockchain, which is something I was very interested in a couple years ago when I first heard about it. But I wanted to know if you could, with your extensive experience, what advice do you have for financial advisors navigating the current market conditions, whether they are slightly grim or whether they could be more optimistic about them? I don't know.
Yeah, it's a great question, and part of me, if I had my time again, much as I've loved and continue to love my career in investment management, I've also always thought that a career as a financial advisor would have been very enriching and rewarding.
Yeah.
I think the big challenge, as I've already said, for the industry is the advice industry has to find a way to serve more customers.
Yes.
In a way that they can do that economically in a smart way, they can make money, but also ultimately serves more UK, talking about the UK market. That's not really for, Franklin Templeton is not going to enter the advice market, right? We're not going to deliver pensions, for example. You can buy a pension from Franklin Templeton. Hopefully we'll buy some smart pensions that are powered by Franklin Templeton technology and investments. But we're not going to be delivering kind of advice into the market. We're essentially an investment manager. So I think when I look at the advice market, whether you're a wealth planner, a more traditional client stockbroker, or you're trying to deliver a robo-advisor, simplified guidance into the market, I think, and probably my answer would have been the same if you asked me 10 years ago, right? Irrespective of current markets, I think you have to focus on your core competency, as in you don't try and be too many things to too many people. We've seen more wealth planners, I guess, outsource portfolio construction and fund selection to kind of discretionary fund managers, multi-asset providers, fund managers. I think that's the right thing to do, because it frees the advisor to be focusing their service proposition on holistic advice, life planning, wealth planning. So I think focus on your core competency, know what that is. You cannot operate now. The second one I'd say is you cannot operate now without being completely transparent on what you define as being valuable and what value is. So we've seen that with the assessment of value framework imposed on fund managers. We're seeing it with the consumer duty. I think people have to be very clear now, and it extends into costs and charges and fees and how what you pay for platform versus advice versus investment management. But I think being proactively transparent on what constitutes value is really, really important. And third and lastly, I think this is a consolidating market. It's a complex market. There's lots of different participants. The boundaries between who's a wealth manager and who's a fund manager and who's a platform and who's that's all blurring in many cases. But I think if you focus on what you are as a core competency, you're going to have to find trusted partners in the market. So I think you focus on what you're good at, be able to define what value is and work with trusted partners is where I think, I qualify that by saying we're not an IFA. So somebody could be listening to say, he's talking total rubbish. He has no idea. But that feels to me, based on my engagement market, where people are focusing.
No, I think that is quite accurate. And also, like, touching on that consumer duty piece, and given the ever-changing regulatory environment, how does Franklin Templeton ensure compliance while staying agile to capitalize on emerging trends?
The simple answer is we take it very seriously. So we engage. I think we're very fortunate in this country to have the Investment Association being as well resourced and skilled as it is to talk with one voice to regulators and government on behalf of the industry. And we're very active.
Yeah.
Franklin Templeton has this, clear view that yes, we're a global business, but we operate in local markets, and we have to be seen to be, and we are leading in certain key markets, and the UK is one of those. So, myself and a number of colleagues are highly engaged in work with not just the Investment Association to the regulator, but with the regulator directly. I'm seeing them this week, for example, on the subject of tokenization. I met with all their senior leadership last week. You have to have really good engagement. The regulator will never give you a massive 10 out of 10 big green tick in the box, because that's not what regulators do. But to help minimize the kind of some of the noise we get in the market, it's just smart to have a professional, highly engaged relationship with regulators. So that's something we invest in a lot. I would say that we're a large firm with large resources, and it's an easy thing to do. Even as a large firm, it's not easy to dedicate the time and resources we need to do all of that properly. So I do question, how sometimes some of these smaller firms might be able to do the same thing. But we're highly active. We also we think deeply about policy, so we always try to participate in consultations, generally by the IA, but sometimes direct on UK, EU, international regulatory policy work and government policy.
And taking more of a forward look for this final question, what do you envision are the future trends and challenges in asset management, and how do you think Franklin Templeton is preparing for them?
So look, I think we've probably covered some of this. So I would summarize it, Kimberley, by saying I think the asset management firm of the future will be on top of the technology that's driving change in the market. It itself will know what its core focus and competency is. I think we will work with perhaps fewer client relationships overall, but we will engage with those clients at a more deeper level. And one thing that we will continue to do, because you have to, is we will invest and continue to invest in our brand. Because at the end of the day, consumers making decisions based on advice from professional advisors or outsourcing responsibility on a discretionary basis to managers who then select funds or strategies from people like us. You can't be invisible. You have to have a brand that is known, that is trusted, that is engaged. So it's very busy. Whether you're looking at technology, the advice market, the asset allocation, alternatives investment market, the ETF market, passives versus active. That's not going to go away. We're going to see, I think, more solutions than componentry end products. But again, to be credible in the solutions market, you have to have a brand that people can engage with, push and pull, and ultimately trust. But what a great time to be in our industry. I mean, with all the challenges we have, it's such an interesting, intellectually interesting, commercially interesting, stimulating market to be part of. And I think we're all very lucky to work in this industry in whatever capacity.
Yeah, and I think it's always rapidly changing, so it's always really interesting to see where it will go.
Yeah, absolutely. I said to somebody today, that the graduate coming into our industry today is fundamentally going to have to be equipped with a different set of skills and knowledge to, me 30 odd years ago, excuse me, as an English graduate.
Definitely. But thank you so much for speaking with me today, Martyn. It was a very insightful conversation.
It was my pleasure, Kimberley, and good luck with the rest of the program.
Thank you. Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.